They're calling it a rally. But rallies don't look like this. When gold and silver move straight up in near vertical fashion, that's not enthusiasm. That's abandonment. It's the sound of capital deciding it no longer trusts the paper it's measured in. Here's the contradiction. On the surface, markets look strong. Prices are higher, assets are soaring, but underneath, confidence is collapsing. Investors aren't chasing returns anymore, they're running from exposure. Now make this personal. When money itself stops acting as a stable reference point, your savings don't just lose value slowly. They're repriced against something real, all at once. And that process doesn't wait for warnings. This isn't a normal bull market. It's a signal that a debt-heavy system has hit a refinancing wall it can't climb over cleanly. Bonds stop absorbing risk. Currencies start absorbing the damage instead. And here's the part almost no one wants to say out loud. This kind of move doesn't happen at the start of a problem. It happens when the exit doors are already crowded. The real question is what broke first to trigger this shift. The first fracture didn't come from metals. It came from bonds, specifically from the places that were supposed to be boring, predictable, safe. That's where the warning lights started flashing. Yields rose not because growth was strong, but because buyers began stepping back. Demand thinned, liquidity pulled away. One country mattered more than most, Japan. For decades it acted as a silent stabilizer, exporting capital and keeping global borrowing costs suppressed. That flow masked stress everywhere else. Now that flow is reversing. As domestic yields climb, capital is being pulled home, and that shift removes one of the largest structural buyers, just as the United States faces a massive refinancing burden. Treasuries hit the market, but the bid isn't there like it used to be. Here's the reframing question. What happens when the world's biggest debtor loses the world's most reliable buyer? Markets answered faster than policymakers. Long-term yields moved independently. Bond prices fell despite reassurance. Because this wasn't about rate policy anymore. It was about balance sheets. And once a bond market starts pricing solvency instead of guidance, control erodes quickly. That's when the feedback loop begins. And that's where the story accelerates next. Here's the shift that changed everything. Control didn't slip. It vanished. When yields rise because of inflation, central banks still have leverage. They tighten, demand cools, expectations reset. But when yields rise because confidence in repayment weakens, those tools stop working. Cutting rates doesn't help, talking doesn't help, credibility is already gone. That's what the market started signaling. Notice what didn't work: reassurance, forward guidance, even the idea of easing. None of it pulled yields back down, because investors weren't reacting to policy anymore. They were reacting to risk they could no longer ignore. This is where the story flips. Once a bond market prices solvency instead of growth, every solution creates a new problem. Support weakens the currency, discipline threatens the system. There is no clean move left. And here's what's missing from the public conversation. No serious plan to absorb pain and restore trust. No willingness to defend the currency at the cost of instability. Instead, the only path left is liquidity, expansion, delay. Markets understand that choice instantly. That's why capital doesn't wait for confirmation. It moves into assets that sit outside the promised structure. Not because they're exciting, but because they don't default. And once that movement starts, it doesn't reverse on speeches. Because the next layer isn't financial anymore, it's geopolitical. Once money becomes a weapon, the global rules change. Trade stops being about efficiency and starts being about leverage. Tariffs replace cooperation, access replaces trust, and currencies stop acting like neutral tools and start acting like pressure points. That shift is already visible. The era of a strong, globally friendly dollar is fading, not because it failed, but because it no longer serves national priorities. A weaker currency becomes useful. It supports domestic industry. It punishes foreign dependence. And it quietly transfers the cost to anyone still holding dollar claims. Here's where the escalation accelerates. As tariffs rise and alliances fracture, central banks stop moving in sync. Policy becomes national, strategic, transactional. Monetary independence turns into a tool, not a principle. Notice what this triggers. Foreign capital pulls back, reserves are reshuffled, assets tied to political permission lose appeal, assets that exist outside the system gain it. This is where the story flips again. Because once globalization unwinds, pricing stops being universal. It becomes regional, fragmented, competitive, and that fragmentation pushes the world into a phase it hasn't seen in generations. A fight over resources. When resources become strategic, markets stop deciding who gets them. Governments do. That's why extraction is no longer treated like a business cycle. It's treated like national security. Projects that sat idle for years are suddenly urgent. Permits accelerate. Executive orders appear. Regions once labeled too remote or too expensive are reframed as essential. This isn't subtle, it's a shift in priority. Here's the detail that matters. When states move directly into resource acquisition, price becomes secondary. Timelines stretch, costs stop acting as constraints, supply gets locked in before markets have a chance to adjust demand. That changes scarcity itself. It's no longer just about what's in the ground. It's about who controls access. Now stack the pressure. Energy transition, military demand, infrastructure rebuilds, all pulling from the same finite pool of metals. At the same time, this is where the story stops being theoretical, because once resources are designated as critical, they don't flow freely. They're rationed, reserved, stockpiled, and that sets up the next problem. What happens when demand keeps rising but supply can't respond, even at much higher prices? That's where the system starts to crack. What looks like a price spike is actually a supply failure being exposed. Silver makes that impossible to ignore. Most of it isn't mined on purpose. It comes out as a byproduct of other metals. That means higher prices don't unlock new supply the way people expect. They just reveal how little slack the system ever had. For years, investment dried up, ore grades declined, projects stalled. Now demand surges all at once from energy, technology, and defense, and there's no fast response. New mines take years to build. Closed ones don't restart on command. Here's the unsettling part. Even extreme prices barely move production because geology doesn't care about markets. Now watch how this escalates. As physical availability tightens, paper markets keep issuing claims as if supply were infinite. The gap between what's promised and what exists widens quietly. That gap only stays hidden as long as no one asks for delivery. But that's exactly what started happening. This is where pressure turns into panic. Because when buyers demand the real thing, the system has to choose who gets metal and who gets cash. And once that choice is forced, the next stage isn't volatility, it's rupture. That rupture doesn't come with an alarm. It shows up as a behavior change. Contracts that were always rolled suddenly go to delivery. Not by small players, but by institutions that understand the inventory math. Physical metal leaves vaults faster than it can be replaced. And systems built on assumptions start to strain. This is where leverage becomes visible. For years, paper markets functioned because almost no one asked for the underlying asset. Claims stacked on claims, efficient on the surface, fragile underneath. Now that balance is breaking. When deliveries spike, exchanges face an impossible choice. Honor the promise and drain what remains, or change the rules to protect the structure. Either way, confidence takes a hit. Notice the shift. Paper prices keep printing, physical premiums explode, settlement delays stretch, the market stops acting unified. Here's the part that matters. This isn't speculation running wild. It's access being repriced. who can get metal, who can't, and who gets settled in something else. That's why pricing power starts moving, why activity shifts, why the old benchmarks stop commanding trust. And once a market fragments like this, it doesn't heal quietly. It splits. Once a market splits, the old price stops being the price. Value migrates to wherever delivery is guaranteed, not promised, not delayed, guaranteed. And that center of gravity has been drifting for years, quietly away from paper-driven hubs and toward places that prioritize possession. In those markets, metal isn't a trade, it's a reserve. It's accumulated without leverage and held without deadlines. When supply tightens, prices adjust upward immediately because access matters more than optics. In contrast, paper markets still rely on confidence, on the assumption that settlement won't be tested all at once. That assumption is weakening. Here's the detail that changes everything. When regional prices diverge and arbitrage fails, you no longer have a single global market. You have parallel systems operating on different rules, one priced on claims, the other priced on reality. And when those systems collide, repricing isn't gradual, it's abrupt. This is why the next move doesn't require panic or headlines. It only requires one more confirmation that physical supply outranks paper promises. By the time that confirmation is obvious, positioning will already be finished. What all of this leads to isn't a crash, it's a reset of reference points. When debt can't be refinanced cleanly, when bonds stop anchoring trust, and when paper markets can't guarantee delivery, value has to relocate, not emotionally, structurally, away from promises and toward possession. That's what this repricing really represents. Not excitement, not speculation, a quiet decision by the system to redefine what counts as money, collateral, and security. Here's the insight to hold on to. Resets don't arrive with sirens. They arrive when old prices stop answering real questions, when benchmarks lose authority, when behavior changes before language does. This isn't the end of a cycle, it's the end of an assumption that confidence can always be restored without cost. Once that assumption breaks, value doesn't drift back. It settles somewhere else. If you want to understand where it's settling next, stay with this channel. Because the next phase won't announce itself. It will reveal itself through silence.